A Bear Market Guide. Chapter 1. Bear Market. Bear Market 1. If something is too good and hot, it can't stay like that. It will go down. Money has often been a cause of the delusion of multitudes. Sober nations have all at once become desperate gamblers and risked almost their existence upon the turn of a piece of paper. Men, it has been well said, think in herds. It will be seen that they go mad in herds, while they only recover their senses slowly and one by one. Charles Mackay, Extraordinary Popular Delusions and the Madness of Crowds, 1852. Let Wall Street have a nightmare and the whole country has to help get them back in bed again. Will Rogers. The safest time to invest is when the streets are full of blood. The worst time is when everyone is walking around thinking everybody's getting rich. Markets can fall much harder than you think. Beware of market hysteria. Whenever there's a brazen bull, get ready for a bear. As I watched PBS's, PBS.org, show American Experience about the 1929 crash, it struck me how true and cyclical the phenomena of the crash in the stock market is. It's like the guy said, every 20 or 30 years, the new generation forgets the lessons of the past generation and there comes a point where market investing loses all common sense in the growth and profits of companies but takes a life of its own based on its own hype. When this point hits, when everybody is hyping up the market and everybody is getting on the bandwagon, all intelligent people should know that this is the time to get out. Another lesson that was reinforced in me was that of the insiders, the people in the money business. Their interest is always to promote the money business. They don't tell you the stock market is bad. It's like asking a barber if you need a haircut. You always do according to him. In this show, these guys were saying the market was fine right up until the big crash. In the most recent crash of the internet stocks followed by the entire tech sector, the pattern was repeated. Human nature does not change. They were exactly the same in the 1920s and 30s. Learn from the past. When the hype is monumental and the market takes a life of its own away from good sense, that's the time to get out if you can resist your sense of greed. The most common phenomena in stock market investing is that the insiders and slicksters are making money and hyping stocks up, and this is played in the mainstream media, whereupon average Joe gets in, buying high, then the insiders and slicksters cash in, leaving millions of average Joes out there holding the bag as the bear hits. When a raging bull market takes on a fantasy quality of trading in phantom companies with no substance backing them up, get out fast because the dam of greed is about to break. Don't get greedy. With every bear, there will be a bull again. When that bull happens, invest in it, watch it go for a while, but when the hype gets too stupid and nobody thinks they can lose, that's the time to get out. Don't hang on for the last minute because bears come quick. It crashes overnight, so as soon as you see enough prosperity for a while, know that it's time to come down, so be wise, sell your stocks and keep your money out of the market until you sense the bear is easing up, then buy good stocks again while they're cheap. Somebody will always be forecasting doom and gloom. Don't listen to them. Listen when the mainstream media money experts start talking bear and get out, but by then the bear will have probably started. You will lose something, but get out now before the mass panic that will ensue that will drop the market to horrible lows. Yes, it's mass panic, but this is the way it works. Get out at the beginning of the mass panic rather than watch your money wither away into nothing. The only realistic solutions are to focus on single stocks that are mostly recession-proof, companies that sell the staples, and focus on the long term. Don't listen when the slicksters talk about either a bull or bear market. Just hold on to your few good stocks for 10 or more years through thick and thin. In a bear market, virtually all mutual funds will go down because they are compilations of a lot of stocks, but a few good stocks as your portfolio will weather the storm better, in my opinion. The financial media in general thrives on hype, i.e. positive news, because this is what gives it ratings, which is its business, to get viewers looking their way. They don't like to report on a negative market, so expect hype from them. Simply using common sense, you should be able to sense a bear because a bull will run its course then go crazy bullish just before the fall. It happens all the time. The bull market is strong and steady, then it goes into a frenzy, after which it crashes. When it's as good as it can get on Wall Street, get out then. Don't wait around for the crash. It's the nature of the market. Regardless of what is fueling the bull market, it will crash. Some people say there's a shadow government around made up of big-time bankers that can cause bears simply by raising interest rates and tightening the money supply, thereby stopping investment and corporate growth. I tend to agree that there is a group of fat cats who meet annually and discuss their plans, which the major media doesn't report on since they own the major media, and with a few simple maneuvers, they can plunge the world into the depths of depression or into a boom economy if they want, and they have been doing this throughout the ages in the modern world. There is a predictable cycle in the markets if you care to look: unchecked growth for 5 or more years with very little failure or negative news, if any, a period of frenetic euphoria followed by a crash, then a bear for several years followed by another bull. Learn from history if you are motivated enough to bother reading about the history of Wall Street, but most people are too lazy to bother. These are the same people who follow the hype of the euphoria before the fall, then complain that they were duped by the fat cat insiders. It's your own fault. Nobody forced you to play. You got greedy, thought you'd make some easy money, but these fat cats were 3 steps ahead of you. They suckered in several million people like you, then cashed in while you held on waiting for the big score and got the big crash. You want to trust what any Wall Street insider says? Go ahead, be a sucker. A recession is technically a decrease in the gross national product, the sum of all goods and services produced, in 2 consecutive quarters. Everyone loses. It's a psychology that the country and the world takes on. Some stocks stay good but most fall. Don't be afraid to liquidate when you feel a bear coming on. Resist the temptation to follow the bandwagon of optimists and brokers urging you to buy. It's time to sell. They're too often the clouds of fear and fantasy. Nobody wants to know a bear market is about to happen, but try to be honest with your gut feelings. Invest when the going is good, get out when economic indicators start to go south. Whether you believe governments and their business tycoon allies can manipulate their society or not, the truth is that they don't want people to be too prosperous because that creates laziness, liberal attitudes, decadence, and opposition. So when any society reaches a certain level of prosperity, it's wise for the government to tighten the reins to make life harder for the plebeians, to keep them worrying about earning enough money rather than doing wild and crazy things that will cause hassles and wreak havoc. When you see a period of prosperity for 2 years or more, have the sense to realize the cycles of life will make it come down too soon. This is the way it works. Somebody said the best time to buy stocks is when nobody wants to be in the market. The worst time to buy stocks is when everybody wants to be in the market, so that means buy in the bear, sell in the bull. Neither lasts forever. Whenever there's a bear market, that's when you will find the good bargains that will make you wealthy when the market turns around. Bear market 2. Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. Sir John Templeton, 1994. Think of the money supply of any country or the world in general. The governments and banks have control of the prime lending interest rates. The way it generally works is that when the lending rates are low, this is good for the business of the economy because businesses borrow money to invest in their business, which has a multiplier effect on the economy, and since jobs are plentiful and the interest rates low, people borrow money and spend it. This is all great for the economy. The governments and banks can wipe out this boom anytime they want by raising interest rates and putting out a bit of propaganda about the rising cost of energy, the rising rate of inflation, and publicizing a few planned shutdowns, which incidentally happen all the time because the economy is always in flux. There is always some factories closing while others are being built. The important thing is the effects of all this stuff on the collective psyche of a nation or even the world. I'm sad to say that a lot of recessions, therefore bear markets, are caused by the people themselves, by their emotions. They act like sheep. They hear some bad news, start thinking conservatively, saving their money, not spending it. Multiply this sentiment by millions of people and it has a negative effect on the economy. There is some precipitating event like the price of oil goes up, inflation increases, consumers spend less, the trade deficit goes up, a few big factories close down or something like this is reported on the news. All of a sudden, people start to panic and think the stock market is going to hell, so they all add to it by immediately selling their stocks. There are no buyers. Nobody wants to buy, so the sellers have to lower their prices. This is the bloodbath of the bear market. Watch this interplay between the government, the news, and the way people react. It's all clear if you're aware enough to see it. Watch how this so-called news affects the stock market. It's largely an emotional thing based on the sheeple effect. Go to themoneymasters.com to check out this phenomena about how our economies are manipulated. When the market tops out and everybody that has extra money to spend is in, that's the time it will go south. When there is irrational exuberance for several months, get out now. This is the most important rule of forecasting a bear market. When everybody around you is thinking of getting rich in the stock market and the stock market is going through the roof, think to yourself how stupid they are. They have no memory. It's about to crash. If you're smart, you'll sell all your stocks, wait until the bear hits, then buy your favorite stocks back at bargain prices. It's like a bloodbath. There will be bloodshed. There has to be, then after it's done, everything returns to normal. Some stocks are recession-proof, but it's hard to pick them. Stick with basic products that people need no matter what. Everybody in the securities business, including the government, the brokers, the analysts, and the media dudes, have a vested interest in being bullish. They make their money when the market is bullish, which is why they will always be bullish no matter how bearish the market gets. Do not listen to them. Don't listen to the doom and gloomer crowd too much either. Keep a level head. It's simple. As long as most stocks are making some gains, you're all right. As soon as you see the irrational exuberance and the too rosy outlook, watch the markets every day and be ready to liquidate as soon as you sense the bubble is about to burst. Don't listen to too much out there. There will always be doom and gloom and prosperity optimists out there, each with their own vested interests. Don't follow any of them. Try to pick stocks that are bear immune and always needed regardless. Food, drugs, medical equipment, soft drinks, telephones, banks, utilities are all good basic stocks. Virtually all the great investors I have read about don't follow the pop trends in investing. They invest in good solid companies that ride bear markets pretty good anyway. A lot of the best investors don't even bother with tech stocks much. They buy the dull, mundane, steady stocks. Utilities, drugs, household goods, and food always do well in a bear market. Sell anything that gains too fast too quickly. Buying a stock that has fallen drastically thinking you're getting a deal is foolish. Some stocks go to zero. Nothing lasts forever but Coca-Cola. The best sectors are consumer staples, food, clothes, financial services, banks, healthcare, and utilities. Buy only stocks that you know people will need. Always diversify. When in doubt, leave your stocks there before you panic and sell low. When you see a bull coming, look for stocks of products people buy when they're doing all right, like new cars, new houses, motorcycles, speedboats, leisure products, etc. You can always invest in rental real estate. Bear market rallies are sometimes short-lived, so be ready to sell at the first sign of weakness. Bonds are always safest but yield the least. A bear market will cause most mutual funds to go lower. The best ones are asset allocation/flexible funds, contrarian, global, utilities. Some people try to hedge their bets by investing globally, but there's always a chain reaction. A bear in a major country means the others will follow suit to some extent. Bear market 3. What goes up, especially quickly as with a bull market, usually goes down to a bear market. Be ready for it. Don't invest in aggressive upstart stocks. Keep your money in more stable, older stocks in such industries that are always in demand, like food, soft drinks, pharmaceuticals, telephones, utilities, tobacco companies, gold, department stores, banks and hardware. When anything is on a bandwagon, that's the signal to get out. The truth is that nobody knows the future, so beyond the bandwagon effect, don't listen to anybody. A booming economy almost always bursts at some point in time. Look at the economy as a whole, the changing rates of inflation, unemployment, new IPOs, the interest rate, market indexes, etc. to get a feel for where the economy is going. If you feel a bear coming on, bail before it hits, then park your money. Conversely, if you make a killing, get out now before the bear hits, then buy when the bear is in full bloom and ride out the next bull. Small stocks generally lose more than big stocks. Gold generally stays stable no matter what. Mutual funds lose as much as stocks do, but low-risk funds and stable stocks are generally best. Once you have been through one bad bear, you get real conservative for the rest of your life. Optimism is nice, but blind hope is foolish. Bears will always rise again, that's your solace, but if you pick stocks based on hype and hot air, they won't, so stay with stable stocks. You might not make quick big profits, but at least your money will be safe and you will make something, which is much better than losing it all on aggressive stocks that generally shoot down like a bullet when the bear hits. In fact, that's often a cause, all those overinflated stocks people got sucked into by the hype. You can get pretty cynical during a bear market, so cynical that you will see all the times the stock market went down in the past, then wonder if stocks are really worth it. If you have got enough money to live comfortably, why risk it on stocks when you can sleep better by putting it in a CD that gives you 5% or so? Absolutely nobody knows what will happen tomorrow. The institutional investors are always bullish, while are always some doomers and gloomers around, so listen to yourself rather than listen to them. The federal interest rate really doesn't have much to do with the stock market. There are many other forces at work that supersede the interest rates on loans. Bear markets are generally quite predictable. First, some major companies report less than expected profits for their quarterly reports. The unemployment rate goes up a bit. Housing starts go down. Companies start laying off employees because the unemployed workers are now buying less of their product, therefore their productivity goes down. The Federal Reserve lowers interest rates to try to instill the multiplier effect, to get people to borrow money and spend, which hopefully causes a ripple effect in the economy. This little trend snowballs in the minds of so-called experts and traders, who all get on a bandwagon and say there's a recession, selling their stocks, which results in panic and a bear market. This may be partially true, but I'm of the belief that consumerism runs the soul of the world, especially America, and there are always a few 100,000 people or more being born or emigrating from third world countries to industrialized countries to become good consumers. So the moral to the story is that bear markets are always temporary, largely an artifact of the fickle human mind and the sheeple mentality. The economy will always expand and get bigger. You just have to pick good stocks that can stay steady during the bear, when virtually all stocks drop and increase rapidly during the resurgent bull market. Based on my own experience, a bear market works as follows. Something happens. It doesn't really matter much what it is, except that investors in stocks and funds panic and start selling off their stuff to get the cash and run with it. This creates a ripple effect of panic and all the sheeple follow, the net result being that demand for stocks is low. Hence prices drop to try to sell them. From my own observations, the large stable companies may falter a bit, but they stay pretty steady. Many of the smaller companies lose big time, and most funds lose because they're mostly spread over small companies. When the recovery hits, the big companies bounce back quickly. Smaller companies may not bounce back proportionately, often bouncing back less than the bigger ones. Mutual funds bounce back a bit, but because they're tied up in small stocks, they don't bounce as high as good companies. The morale to the story is to buy recession-proof stocks. Even though super big stocks are the most stable, I don't bother much with them because gains are paltry next to a smaller good stock that is so good that it can withstand a bear. I won't give away all my insights in case they turn out to be wrong. Use your head, figure it out. Telephones and medicine will never decrease. They will always increase as a whole, but you have to consider competition. People need pacemakers regardless of the state of the economy, but if there's a bear, people won't buy their luxury items like their Harley, the speedboat, or the trip to the casino. Think it through for yourself. Once again, money stocks always win like Charles Schwab. Freddie Mac and Sally Mae always win pretty steady gains. They make money regardless of whether the stock market loses or wins through commission fees. Somebody said when the large stocks are gaining but the small stocks are losing en masse, be ready for a bear market 4. When stock prices go crazy, get your money out. The crowd never thirsted for the truth. It turns aside from evidence that is not to its taste, preferring to glorify and to follow error, if the way of error appears attractive enough and seduces them. Gustav Le Bon, on crowd psychology. Better to sell too soon than too late. People want to be seduced, and if they sense everybody else is following the delusional seduction, they feel safety in numbers and go along with it even though your inner voice is telling you that everybody is nuts but you. Never confuse any type of market with brains. As a guy who's survived several bears, I have realized that there will always be bears caused by panic, and the only way for me to get total peace of mind is to get out of the glamour of glitzy high-tech stocks and stick with the stable retailers, not the internet retailers but the Walmarts and the Home Depots, plus a few good infrastructure companies like telephone, cell phone, a few banks, and that's about it. You won't gain as much but you will sleep better and won't lose as much when the idiots of Wall Street go crazy, cause in the final analysis, they're all sheeple. The panic usually hits in one swoop fell and a bunch of small investors fall, but stocks generally make their best gains after a slump, so resist the urge and hold if you know the company's any good. Pick good stocks, buy and hold. Generally after a recession starts to wind down, people start to feel good and buy houses, so home and hardware stocks are generally pretty good as well as car stocks. These are the basics of the American dream, a house and car. Everybody wants one, so if the economy is picking up, these stocks will too. This works in reverse too. If the economy is going down, get out of housing and cars because they will be too expensive for average Joe. He will rent a trailer and drive an old clunker for the time being. Buy food stocks with major suppliers who have very little competition. The Consumer Confidence Index monthly retail sales reports are a big indicator of the bearishness or bullishness of the market. If they go down for 2 months straight, expect a bear, and if they go up, expect a bull. In addition to housing, buy consumer goods stocks like appliances, stereos, furniture, etc., basic things for the home. The best stocks in a bear are the essentials: drugs, food, gold, household products, oil, soft drinks, telephones, utility companies, electric. If you feel a bear coming on, get out of growth stocks and into stable blue chip stocks. Healthcare and financial services are generally stable stocks. The basic rules of how to survive in the stock market are: don't buy when a bull goes into high frenzy no matter how much hype you hear. Buy when interest rates are high, nobody's investing in anything and the real estate market is flat. You make money in a bull market. In a bear market, be happy with breaking even or cash out and put your money into a money market fund or CD. Be a conservative investor. Stick with Warren Buffett type stocks, boring, conservative, steady companies that sell the staples. Buy with the expectation that you'll hold a stock for at least 5 years. After 5 years, when you see a bull market getting frenzy, sell all your stocks, get out of the market and watch for a year or 2 until the bear bottoms out. Look into other types of investments like real estate and foreign stocks in other countries, some of which are sold on American stock exchanges. Nobody has a crystal ball, but you can bet on the up-down cycle of the stock market. The pessimism of herd mentality. I scan the business news in the newspaper and the shows on CNBC. It's all doom and gloom and the people follow. Doom and gloom breeds more doom and gloom. I'm immune to it because I don't play the stock market like I used to. I have few material needs and no payments on things that are too big for me, like my house, or expensive toys, because my life is what I do every day to release the natural spirit inside of me, not what I own beyond the basics for a modestly comfortable lifestyle. It's all I need, so I'm not like those sheeple out there all depressed because their stock portfolio went down. I think doom and gloom is good if it helps us as a society to get rid of that fake world they portray on the entertainment news shows and silly TV commercials for hair color and cosmetics, but I haven't seen it, so things couldn't be all that bad if they're still harping on Brad and Jen as if the collective mindset of society really cares about the lives some hyped up, overrated people. That's why I'm laughing at the world. You created this mess through this awful lifestyle of excess that the modern world operates on. I wonder how all those home decor stores are doing now? I hope they all go out of business and people start to get real, but I'm way too smart for that. People won't change until they're desperate and their credit is gone. If you seek happiness through consumerism, sooner or later, the world will run out of resources unless you can renew them. The solution is simple. Go to down-to-earth living. Bear market resources. Try number 332.632 or HG4551 HG6041 at the library. fallstreet.com. valueline.com